Graham for a closer look at sectors of the market that have outperformed for investors. Let's begin, Gavin, with fixed income, particularly government bonds.
Yeah, and if you've actually got the traditional 60% equity, 40% bond portfolio, Paul, you're actually doing a lot better than pure equity. But again, that's just reinforcing the point why you have a diversified asset portfolio, because you want assets that don't always move in line with each other. And in fact, as worries have grown about the possibility of a recession caused by the imposition of tariffs, one of the things that's done is made people more convinced there's going to have to be interest rate cuts, even though, ironically, as Tiff Macklem and Jerome Powell have been making the point at the Bank of Canada and the US Federal Reserve, interest rates cuts aren't particularly effective dealing with the effects of tariffs. But what they've also made it plain is that they will sort of look through any inflationary aspects caused by the imposition of tariffs if they feel there's a need to cut interest rates. And if indeed we are, as one or two major executive figures are saying in the US is now flirting with recession, and we know there are concerns about Canada being put into recession because of the effect of tariffs, then you're going to see lower interest rates, and that's good news for bonds. So therefore, you've actually seen the bond index as a whole. I think it's the XBB as the Canadian bond universe is actually up a bit so far this year, even before taking income into account.
Okay, let's go to areas of the stock market which have outperformed. One of them is utilities. I know you flagged a utilities ETF, the iShares S&P TSX capped utilities ETF, ticker symbol XUT. We can take a look at that one. It's only off about 2% so far this year. We see a steep decline there at the right end of the graph, but it has outperformed the broader equity market. Talk to us about utilities and the value that they're providing right now.
Well, again, you've got a two-pronged threat here. The first one is recession, which means that people will cut back on discretionary expenditures, but there isn't anything discretionary about having to light or heat your house. And therefore, utilities are always regarded as being very stable, nicknamed widows and orphan stocks, precisely because they're going to keep on being able to charge people for gas and for hydro. And as a result, they are able to continue to pay their dividends because you're picking up a 3-4% yield on a lot of these. Fortis, Emera, Hydro One, all of these are actually doing very well. The other point is, of course, if there is going to be tariffs being imposed, these are domestic companies, so they're not particularly exposed, maybe at the margin, because there'll be lower demand from industrial users, but that's at the margin. So these ones do look particularly attractive, and you can add sort of pipelines to those as well, because again, they have fixed price contracts or take and pay contracts, so they're very stable sources of revenues, and that's quite a big chunk of the Canadian market as opposed to its relatively low exposure to technology and economically sensitive areas. So that's one of the reasons why the TSX is down less than the S&P.
Should investors think about moving into sectors like these now?
Absolutely, and in fact, again, we touched on the fact that you still probably have very good profits on a lot of these large cap tech stocks. Some of them are still actually up over the last 12 months, even despite the enormous sell-off in the last couple of months. Why not actually reduce your economic activity exposure or the sensitivity to economic activity if there are concerns about what might happen, and be in stuff that's boring. But in this case, boring is good, boring is stable, and that's a good place to be.